Welcome to Retirement Revolution. My name is Cynthia DeFazio. I'm joined today by Randy Locklier, and Randy is the president and founder of Gulf Financial Group. Randy, how are you today?
Fantastic. I'm excited to be here.
I'm excited to have you because I know you've been so busy and the show is doing so well for you. What's life been like in the office?
Well, it's been a little crazy, so we're booked up full of appointments, you know.
Yeah.
But still, we try to give everybody the highest level of service, so we'll spend time.
Well, you always do that with such grace and ease, so thank you so much for that and for taking the time to come in today. Let's talk a little bit about risk in retirement. What is that like, Randy, for someone to have risk in retirement? Where can that come from?
Well, you know, risk means that I have the possibility of loss, okay, especially when it comes to my financial assets. So we think it's very dangerous to be in a risky position with your assets during retirement. I know that I was working at one of the major brokerage houses back in 2008. And we had about a 42% market correction during that period of time. And the impact on some of the clients that we had then was they had to go back to work in many cases, or sell their home, or find another way to generate some assets in order to create their retirement, because they were right in the middle of it when they had a market crash. And so certainly any kind of major market move downward during retirement years makes it really difficult to achieve a good retirement. And we think that risk for somebody that's in retirement should be one of the key considerations. You know, have a look at my portfolio and see what the drawdown potential is there, you know, and we can analyze portfolios for that. But everybody has a different portfolio, right? But we have to look at that and see what risk you would bear. If we have an '08 style crash, you know, exactly how would that impact you? Now, we've had several large market crashes just here in the last 20 years. You know, we had the tech bubble in 2001. We had the financial crisis in 2008. Just recently in March and April of last year, the COVID mini crash, you know, 30% down, which we've since recovered.
Absolutely.
But we don't always recover. And so certainly we want to position our clients where their retirement is not destroyed if the markets crash during the period of time that they're retired.
That makes sense, Randall. Thank you so much. Let me ask you about, what about rising inflation? Is that a risk in retirement as well?
Well, it is, because, you know, today's dollars buys a certain basket of goods. 20 years from now, those same dollars will not buy those same basket of goods. You can look at the gas pump and you can really easily see that over time prices do increase. Okay, so it's important to be able to grow our assets, because things will cost a lot more in the future than they do today. So what we call that is purchasing power risk. Okay, will my assets buy everything that I need in the future, just like it does today? And in many cases that might not be the case.
Okay, what about fluctuating interest rates?
Well, this is an interesting time to talk about interest rates. We are at historically low interest rates. Never in my lifetime have interest rates been as low as they are now. The Fed borrowing rate is about as close to zero as you can get. And if you stop by the bank or the credit union and look at what the passbook savings or the CDs are paying, you'll see interest rates are at a really an all-time low.
Okay.
So as interest rates go up and down, it certainly can impact the market. A sudden rise in interest rates could cause bond prices to fall and stock prices to fall. So interest rates are one of the great risks that we face in retirement.
Okay, Randall, let me ask you, what about poorly performing retirement plans?
Well, you know, if I don't have a good plan in retirement, it's not performing well if my fees are too high, if my return is not good, if my risk profile on my portfolio is too high. All of these things can lead into a poorly performing plan.
Okay.
Okay, fees especially, right? If we're paying fees, and a lot of people don't know what their fees are, for underlying investments, wrap fees, account management fees, these can really drag on our return. So that's certainly not performing at a high level if we have fees that are dragging against our return. also, we may have a situation in which we're assuming too much risk in certain parts of our portfolio that could cause us to lose money if we have a bad market period. So we want to make sure that we have a retirement plan that's up to date. We want to make sure it's utilizing all of the current technology, all of the investment products that are out there in today's market to kind of limit that volatility, maybe drive some of those fees out of the equation and elevate the return.
Okay. Randall, what about the possibility of higher taxes in the future?
Well, you know, we were talking about historically low interest rates, and in the last 20 or 30 years, we were also at historically low personal income tax rates. Now, I'm not sure about what everybody's political persuasion is, but certainly taxes may likely go up in the future under a new administration, okay? So when we have taxation that affects our income streams, or if we sell some securities and we have a higher capital gains rate, so taxes are really going to eat into our livable expenses. And so we want to make sure that our clients are well positioned, because it's likely that taxes could increase in the future, especially for the higher earners.
That makes sense. Absolutely, Randy. Thank you so much. What about reduced Medicare and Social Security benefits?
Well, we want to maximize those, okay? But in the future, they may be limited because we know that there are funding problems with the amount of people that are paying into the program now, and so at some point in the future, those Medicare programs and Social Security programs could become underfunded. Well, does that mean that benefits have to be cut? Maybe, okay, and we might see that benefits might be cut for those that are in the higher asset classes or higher earning range, but I don't think we can look at Social Security and say it's always going to be there in the same form and fashion that it is today. So certainly if it becomes a situation in which the budget for that is not being met by the current inflows, we could certainly see decreases in those benefits in the future. And it's important to have a contingency plan in place if that should happen.
Absolutely, absolutely. Well, Randy, it's time for us to open up the phone lines to the viewers at home for the very first time this week. What do you think?
Fantastic. Give us a call.
Awesome. To the viewers at home, the phone lines are now open. That number to call is 833-403-4041. What Randall is offering you today is a complimentary consultation. Let him take a look at what you currently have in place for your retirement. Is it the right plan for you? Does it need to be adjusted or perhaps built from scratch? There's 10 complimentary consultations available to you today. All you have to do is pick up the phone and call and be one of those callers. The number is 833-403-4041. We'll be right back after this very short commercial break.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have, by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
And welcome back to the Retirement Revolution. My name is Cynthia DeFazio, and I'm joined today by Randy Locklier. And Randy is president and founder of Gulf Financial Group. Randy, a great show we're having today, and obviously talking about the importance of planning properly for retirement and avoiding some risk that can happen along the way. Let's talk a little bit about how when you're in the working years and you're going through your life every single day, going to your job, coming home, having a paycheck coming in, how that's different. That's more of the accumulation phase of your life. What happens when you shift into retirement and you have the distribution phase going on now?
Well, we think there's a radically different way to manage money during that situation, right?
Okay.
So if I'm making dollar cost averaging contributions into my retirement employer plan through a payroll deduction, I'm putting money into the plan constantly while I'm working, okay? I'm also probably younger because I'm still working, so I can afford to take on a little more risk.
Okay.
Okay, but when we retire, the situation changes. First of all, I'm no longer making contributions into my retirement accounts through a company plan or through IRA contributions.
Sure.
And now I've shifted from a situation where whether I'm taking money out now or not, at least when required minimum distributions start, I'm going to have to start drawing that money back out. So we see the shift from accumulation phase, I'm growing my money for future retirement, to asset preservation and distribution phase.
Okay.
So we believe strongly that we should manage those assets in order to preserve them. Let's make sure that they are there.
Okay.
And we also believe that we should create distribution mechanisms, you know, to generate income to draw that money out. But in this case, we can't be taking the same kind of risk that we were taking when we were younger.
That makes sense.
Because if I'm 45 and the market drops and I don't retire till 65, there's plenty of chances for the market to recover.
Sure.
Right before I retire. Well, if I'm 65 or 70 and we have a market crash, I might not be here when the markets recover.
Sure.
And so we think there's a totally different approach that's required once we switch over from the accumulation phase to the preservation and distribution phase, and we have some pretty unique strategies in order to accomplish that.
You have the next generation plan.
Well,
And I
next
love
generation,
that.
right? That's what we like to say, because it is a new generation in the financial landscape. Things are not the same. This is not your father's retirement program, okay?
Yeah.
Because if we look back 20 years ago, it was a different landscape. Interest rates were higher, so we could get a good rate at the bank or in a bond portfolio, okay? Not the case today.
True.
So what we like to do is we are going to go beyond what the big box investment stores are going to do, and you know who I'm talking about.
Sure.
If you walk into any of them discount brokers and they're going to hand you a diversified bond and stock portfolio and kind of call it a day. Well, next generation, what we're talking about is, can we improve the performance of the portfolio by maybe getting rid of some of those low performing bonds, and let's plug in some structured products that we can get higher returns, eliminate the fees, and improve the overall performance of the portfolio.
Okay, okay. Thank you so much. Let's talk a little bit about sequence of returns. Can we talk about that, Randy, a little bit?
Yes, of course, and I think this is key also. Now, returns in the market, they go up and they go down, right? They're going up right now, but they're probably going to come back down again.
Okay.
So we do know that markets will have bull markets, and then we'll also have bear markets when they don't do as well.
Sure.
So we know that the returns are going to vary. We're going to have volatility in returns. So sequence of returns mean I don't know when the bad returns are going to come. I know they're going to come, but I don't know when necessarily.
Okay.
So one of the things that we find with working with our clients is if they get bad returns in retirement at the same time that they're withdrawing out of their retirement plans, you get a double whammy, a double dose of reduction in the funds, right? First of all, I'm losing principal to the market volatility downside, and then I'm also taking money out because I have to live on it. And so in these kind of circumstances, rapidly falling markets combined with a lot of withdrawals made to support the client's income, we can see that we can significantly reduce or even spend all of the money that we had set aside for retirement.
Okay.
So we do believe it's important to put some safeguards in place so that falling markets don't destroy our retirement plan.
So a very important question someone in the viewing audience should be asking is if their portfolio is crash proof.
Well, that's one thing we should look at. So at Gulf Financial, we believe in a research-based approach. I like to know what the numbers are, okay? And if we talk about what's called a price-earnings ratio, it's a value measure where you can say, okay, stock is trading at X times what the current earnings are. And the higher that number is, the more overvalued a stock is. Now, these price earnings ratios in the S&P have generally run in that 10 to 12, 10 to 15 range. That's usual. Right now, PE ratio of the S&P is running more like 41 or 42. So we could be in what we call a bubble, okay? And if we're in a bubble, could we actually have a crash, okay? The last few times that we've had PE ratios pushed this high in the market, we have seen that happen. In 2001 and in 2008, we were preceded with a situation of overvalued stocks. So yes, are we in danger of a crash? Could we be in a market bubble? I'm not a wizard or a magician or a fortune teller, but I can tell you the markets will eventually come down.
Sure.
And when they do, you need to make sure your portfolio is crash proof.
Yeah.
So we can use strategies that eliminate the downside or buffer the downside. We can use structured products, annuities, flash notes, lots of different things to make sure that we don't lose money like everybody else is going to when the markets crash.
And you have a way of looking at it like the Texas Hold'em. Let's talk about that for a little bit.
Well, I'm not a big gambler, but I do like to play a little poker sometimes, right? And so Texas Hold'em is a poker game, right? And you're going to bet on your hand, and if you have the best hand, you win.
Right.
So over time, you might amass quite a pile of chips there in front of you, okay? But the one way to make certain that you don't have that pile of chips is to stay in that game and to keep betting all in, and I'm going to keep putting my money on the table and therefore risk the loss of it. So we do like to say when we have profits, when we have wins, let's take a few of those chips off the table and let's stick them down here in the pocket where I know that I can have them at the end of the day.
Okay.
So we've seen a lot of people, you know, they were batting 1,000, right? And they have big investment portfolios and then staying in too long or making the wrong decisions. And those savings can be wiped out. And we want to help you to prevent that here at Gulf Financial.
Well, Randall, this is the perfect time for us to open up the phone lines to the viewers at home for the second time this week. What do you think?
Terrific.
To the viewers at home, the phone number to call is on your screen. That number is 833-403-4041. What you're calling in for today is the complimentary consultation with Randy. Let him take a look at what you currently have in place. Is it the right plan for you? We started the show today with 10 spots open, but now we are only down to 3 remaining spots. So please don't miss this opportunity. Once again, the number to call is 833-403-4041. We have to take a very short commercial break, but don't go away. When we come back, we're going to have viewer questions, and one of them might be yours. You don't want to miss.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Retirement Revolution. My name is Cynthia DeFazio, and I'm joined today by Randy Locklier. He is the president and founder of Gulf Financial Group. Randy, I love this part of the show because the phone lines were going crazy and people like to leave viewer questions for you. This one I thought was a very good question because we mentioned the big box brokers, if you will. They want to know the difference between how you handle a person's money portfolio versus the big box people, if you will.
So we have a very different approach to risk and asset management than you're going to find if you walk into any other brokerage house, okay? Basically, what you're going to get if you go into one of these big box shops, you're going to get a diversified, allocated portfolio, and it's going to be in 3 asset classes: a little bit of cash, some bonds, and some stock, depending on what your risk tolerance will be. If you tell them you're worried about market risk, what they're going to do is say, let's buy some more bonds for you. We don't believe in that at Gulf Financial because in the current situation with the bond market, the yields are not very high. We also have risk in the bond market, default risk and historically low interest rates, fees to manage these bond portfolios, especially if they're in mutual funds, and they just don't yield very high. I mean, if I'm paying 1 or 1.5% to manage a bond portfolio that's earning 2.2, that's not really a smart decision. So what we like to do, instead of using bonds for the safe side investment, we want to plug in structured products like annuities and structured notes, market-linked CDs, things where we can elevate our return and eliminate the fee structure that's associated with that. Because we do believe it's a revolution. There's a different way of doing business, and you're not going to hear about it if you walk into some of these other shops and they sit down and throw a portfolio at you. That's not true financial management or true financial planning. It's more of, you've heard of the robo-advisor, you know, where the computer makes the decisions about what you're invested in, and that's basically what you're going to get in these big box shops. They're not going to be able to buy individual stocks and bonds. They're not going to be able to use any of these alternative products that might be more efficient in your portfolio than bonds. So if you'd like to find out where you stand with your portfolio, give us a call and we'll do an in-depth study of it and report back to you our findings.
Thank you, Randy. That was an excellent response. This is a great question, too. We have a caller that called in from Panama City. What is sequence of return risk? Can you explain this a little bit further? Okay,
sure. So we talked about this a minute ago. So sequence of returns risk is when I have falling returns at the same time that I'm having to draw on those funds in order to support my retirement spending. So basically what we want to do is limit the possibility of large drawdowns in client portfolios. Okay, if we can offer stability with the principal and create income, and basically our clients are going to avoid the large risks that are associated in the market today. And at the time that they're spending money, especially important to avoid those large drawdowns, because in just a matter of years I've seen retirement portfolios wiped out in those kind of circumstances when we've had large market losses combined with a lot of client withdrawals. So we think this is a good thing to plan for, to make sure that we don't suffer if we have market volatility on the downside.
Okay, thank you, Randy. Excellent response. Great question. This came in from Destin, Florida. Bonds are safe, right? What are the risks to having bonds in my portfolio, Randy?
Okay. Well, they're not so safe, okay? We have a lot of risks that are associated with bonds. First off, we have the risk that the bond issuer might go out of business, okay? There's no promise that they're going to be around to pay you those interest rates if the business were to fail or the municipality were to fail, okay? So we can certainly lose all of our money in a bond if the issuer of the bond ceases to pay interest and doesn't pay your principal back. Okay. And it happens all the time. Okay, we also have interest rate risk. Now, interest rates and bond prices are inversely proportional. In other words, when interest rates rise, bond prices fall. Now that brings up an important point, Cynthia, because we are right now at historically low interest rates.
Sure.
So what do you think is likely to happen from this point?
Bonds are up right now, but they're going to go down.
Right.
Yeah.
So when the interest rates eventually begin to rise, if the Fed gets a hint that there's inflation possibility in the economy, they're going to start these quarter-point interest rate increases at every FOMC meeting. Well, when that happens, if you've got a bond in your portfolio, the day that they raise that rate, price of your bond is going to fall. So we already know that the interest rate raises are highly likely, and so if you're sitting in a bond portfolio right now, it's just a matter of time before those rates go up and your principal values begin to fall.
Okay, all right. Thank you so much, Randall. I think we have time for just one more question. This is a great one. It says, you talk a lot about investing in the efficient frontier. Can you explain what you mean by that, Randy, the efficient frontier?
Sure. So we've talked a little bit about efficiency, right? We want efficiency in terms of low fees, net of fees, right? Net of returns, net of taxes. We want to deliver efficiency. But if in particularly the efficient frontier, what that means is, can I develop a portfolio that gets the most amount of return for the least amount of risk? That is when we really operate in the most likely outcome, in that middle range.
Okay.
You know, in the South, we have a saying that bears and bulls make money and hogs get slaughtered. So we can't really be too greedy, right? We would be better to look at more moderate returns that we can achieve with regularity. If you ask me to achieve a lower return, I can do it with a much higher probability than trying to get 11, 12, 13% to try to keep up with the markets, okay? So we do believe that if we can operate have a mindset that we're going to look for moderate, repeatable returns, then we can take advantage of compounding interest year to year and generally protect and grow a portfolio in a reasonable way.
Okay. And Randy, we have about a minute and a half left of the show today. What final bit of advice do you want to give the viewers at home?
Well, I think it's really important. Let's take a look at what your current situation is. You know, if you have a car, every now and then you have to look under the hood. And you have to make sure that everything's running right. Is the maintenance done right on it? Do I have a problem? Is it going to continue to serve me in the future? And so I would just encourage anybody out there that's watching this show, if you don't have a feel for what your fees are in your portfolio, if you don't have a feel for your returns, if you don't have a feel for the risks that you might be taking, come and schedule a meeting with us, because without obligation, we're going to take a look at your situation. We're going to be able to analyze it down to the penny for fees. We're going to be able to pinpoint a risk score on it. So whether we do business or not, I can promise you lots of good things in terms of knowledge about your retirement plan will come out of that meeting with Gulf Financial.
Well, Randall, thank you so much for another amazing show this week. I know the viewers enjoy the information so much, and it's so timely. So again, thank you. To the viewers at home, the phone number on your screen is the one to call. That one is 833-403-4041. If you have questions about your retirement plan and what it looks like, and if you need a tweaking, actually Randall can do that for you as well. 10 spots were available this week. I believe we have one left. Thank you so much for watching. Be safe, be happy, be blessed. We'll see you back again next week.